That might be what we're doing. Is I'll write it out with my finger. Being racist? Yeah. Okay. Okay, let's get focused. Let's get started. And maybe I'll find my writing utensil somewhere along the way. So this week we are talking about financial markets. Okay? Do you have any idea what a financial market is? Anyone? Any ideas?
A market of finance.
Money. So financial market is going to be basically where the money goes and how, especially when we're talking about stock markets and banks and stuff like that. So when we talk about money, we talk about it in the financial system. Oh, this is going to throw me off that I don't have it.
And maybe that's not doing it.
Stop, Joe. Okay? I've already been dealing with 8th graders today. Don't push me.
If I get sent to the office, do I still have to do it?
Yes. So the financial system is all of the banks, all of the insurance markets, the bond markets, the stock markets, everything that allows for a transfer of money and funds between investors and the people who have the money, consumers, bankers, etc. And whenever you have money in a bank system, in the finance system, there are normally two things that you do with it. Okay? You're either going to save it or you're going to invest it. What would you say saving is? What is saving? Okay, it's not just that you're not spending it. What are you doing with it? You're putting it away for future use, right? Instead of spending it. How is investing different than saving though? Okay, you make more money out of it. Any other ideas? You could what?
You could also lose it.
You could also lose it. Okay. When we talk about saving versus investing a lot of the time has more risk. Okay, so investing technically is a use of income to create a future benefit. Investing generally is trying to build money for long term. So if I'm just putting money away with no goal, am I saving or investing?
Saving.
You're just saving. But if I take my money and I put it into stocks or the housing market or a bond or a CD, then I am investing. So we have kind of, a lot of places that help with the saving and investing. Okay? What's one business that you would give your money if you're saving or investing?
A bank.
A bank. That's the obvious first one, right? But what else? Who else can help you save or invest? Any ideas? We started talking about them a little bit last week. It's kind of this great big list, right? We've got insurance markets, bond markets, and stock markets. And when it says market, that generally means that thing is being traded and sold, right? So you don't normally think of insurance as something that's traded and sold. But when you're paying every month for the insurance on your car, guess what? Someone's holding that. It's not just disappearing into thin air. okay? And people try and make money off that money that you are giving them so that they can later on pay for when you have a car accident. And whenever the money is in these systems, in these financial markets, it kind of has a pattern that it goes. Remember our circle from before that had all of the different, here's the people, here's the government, here's all that, the markets. This one's a little different. So we start with the savers. And on the other side of things, we have the borrowers. And right in the middle, we have what's called financial intermediaries, which is just banks or other like funds that hold money. So the savers, they take their money and they put their savings in a bank. That bank then takes that money to give out loans to borrowers. Now the borrowers get to pay back the loans. Hold on 1 second. Oh, sorry, I skipped a part. So the bank gives a loan to the borrower. The borrower uses that loan to buy an asset. Whether that's a house or a car or a boat, okay? And then the bank technically owns that asset and is paid off with that loan with the borrower, right? And the interest that is paid then goes back as interest and dividends to the savers. So all the money that you make in your bank account is actually coming from people who are paying off their car note, paying off their home, things like that, because the bank owns your accounts and theirs. Okay, we got this? Need another second? Okay, so we said these banks right here in the middle can also be called financial intermediaries. So financial meaning money, and intermediate means like middle, right? So they're the money people in the middle. You good if I clear this? Okay. It will be online shortly, and you can catch up. Okay, so financial intermediaries. This is a really long word. Ugh, intermediaries. We have the kinds that are banks and the kinds that are not banks. So the banks, I'm just going to put FI for financial intermediary. Hold on. I messed that up. Banking, they do banking. That is, like the name suggests, going to be things like banks. But we learned last week there are people besides just like banks for banks' sake that do banking services, right? So we have S&L funds or S&L companies. So that's saving and loan companies. Not S in L, but S and L. S and L companies. Remember, they were originally there to provide savings accounts and loans to people, but then they started doing regular banking as well. And then also credit unions. Those exclusive banks, okay? All of those are considered banking financial intermediaries. However, we have non-bank financial intermediaries. So it's not a bank. What could it be? There are lots of other people that handle money besides banks. There are finance companies. There are mutual funds. There are pension funds. And there are life insurance companies. And quite possibly other insurance companies as well. So if you'll notice, all of these non-bank ones are generally there to make profit, to make money. Okay? They're probably what you would consider not as safe investments as just putting your money in a bank. But it's still that thing of they take your money, they use it to invest in someone else and make profit off of it, and then give it back to you with benefits. Now, there are also financial asset markets. So this is where we sell off and we buy back money, right? Which sounds really weird. It takes two forms, okay? And it varies based on a couple different things. So we have the capital market, which is for long-term investment. And then we have the primary market. And the primary market is, oh, I'm sorry. I'm skipping ahead of myself because I can't keep track of stuff on the page. Sorry. There's a capital market, which is the long-term one, and then there's money market, which is short-term. And then our primary market is where new assets come from, so new stocks that the company has just created. Whereas the secondary market is going to be for the resale. After it's already been issued by the company and sold once, that is for the resale. So when Tesla says we have officially gone public, we're going to start trading stocks. We've given stocks to all of our employees. All of the ones the employees get are new assets, so they're primary market stocks. But when those employees start selling them off and trading them, they become resold. They're on the secondary market. Sorry, a lot of this is terminology, guys, and then it's going to build on it next week. Oh, goodness. So, big differences in these four things, okay? Number one is time. Capital markets are normally held for longer than a year, so that's things like stocks, bonds, mortgages, things like that. And money markets are held for less than a year, so things like short-term certificates of deposit and things like that. Okay? So, long-term, mortgages, big loans, money market, short-term, little CDs and stuff like that. If you need to make a note beside that so you can remember, go for it. And then the other is resaleability. How easily can you get rid of it? Or how easily can you trade it in for money? So primary markets, only the original person can make money off of it. Only the person it was given to can redeem it for cash, okay? But secondary markets are based around resale, buy low, sell high, things like that, and making money off of other people's money. Okay, lots of trading and movement going on there. Does all this kind of making sense a little bit? Like I said, it's a lot of terminology. Okay, we good with this? Okay. Reasons to invest. So why do you think you would invest instead of save? I feel like we talked about it a little bit earlier. Your money makes money. Most savings accounts have a really low interest rate, okay? You're making maybe 1% if you're lucky, depending on where it is. When you start moving into investment accounts, like a money market account or a mutual fund, you're looking at making 4, 5, 7%, depending on what it is. So you're making more money with your money. So when you're thinking of reasons to invest and how to invest, you have to think about investment objectives. So basically your goals. So before I decide where I put my money, I have to decide, is it going to be long-term or short-term? You also need to know your income and like the amount of money that you're able to invest safely. It's kind of hard to put $2,000 in a long-term investment if you're not able to put away $2,000 out of 3 months paychecks, if that would put you behind on rent. So maybe a smaller investment is safer. A lot of the time you also want to worry about debts and taxes that can interfere with your investment. So like, do you have debts that need to be paid off first, or that are going to take some of that money from your investment? Or do you have, are you putting your money somewhere where it's tax-free? Because some investments you don't have to pay taxes on. And then also logistics, like, do you need to access that money quickly? Okay, is this an emergency account or not? So savings for emergencies should be a short-term account and it should be easily accessible, right? So that's what my husband and I have a money market account instead of a normal savings account because it's a little riskier to put your money there, but it makes a little bit more money than a regular savings account. However, it is also our emergency fund. We have a debit card for it, and if we need to spend that money on an emergency, it's there. We can access it instantly. Now, you can only have 6 transactions on it because it's still a type of savings account, but we can get to that money quickly. And then, so things like this, emergency savings, it's going to be a savings account or a money market account. And then CDs and bonds are going to be long-term saving and investment because you have to wait out the time for it to be able to be redeemed. You also have to think about your, what would you call it? The risk and return. So a normal savings account is insured by the FDIC. So if the bank goes under, you get repaid by the government. You're going to get your money no matter what with a normal savings account. With a money market account, even though it seems very similar, if the bank goes under, it's not insured by the federal government. So you kind of got to pick and choose what's your priority, how much risk you're willing to take. And that being said, money markets are still considered pretty safe accounts. And different levels of investment have different levels of risk versus return. Okay, when you start playing the stock market, you have a lot higher risk, especially if you start working with stock for companies that are newer or less stable. Speaking of which, let's move on to talking about the stock market. Everybody's good with this? Are y'all asleep today? Or are you just grumpy about the notes? Or both? Ella's sitting back there like, nah, I'm good. Don't worry about it.
No, I'm
Tired, okay. Yeah, no, I slept so much this weekend. I am surprised I'm standing up right now.
How close to done are we?
We're like a little over halfsies.
What?
What? I'm like not even writing everything I have on my paper. So, stock market. When stocks are first issued and sold to investment bankers, this is called the initial public offering. And then they're sold again on the stock market. What's that called? So they don't just release the stocks into the market. They hand it to someone to sell it that first time. Whenever you buy stock, there's a couple reasons to, okay? Number one is to earn dividends. What are dividends? Anyone know?
Stuff you get back from the stock.
Yeah, so if you're holding that stock and that company makes profit, they pay you part of the profit. Not every type of stock has dividends, but some do. And normally, if they do pay dividends, you're going to want to hold on to them instead of selling them off. When I was a kid, my grandmother on my dad's side had some stocks that were in like an oil company. And so about once every month or two, she'd get a check in the mail for the dividends on those stocks. It'd only be a couple $100 or so, but it was something to help her get along because her dad had been a worker for the oil company and had been given shares in the company and never sold it off. And the other reason is going to be capital gains. That's when you buy low and sell high on the stock market. So two totally different reasons to have stocks. One of them you hold on to it and the other you sell it off. And there are also a couple different types of stock to worry about. Goodness. Number one, there is common stock. And number 2, there is preferred stock. So, common stock, the first one, means that you get a say in what that company is doing. Okay? You get to vote on their different actions in the market and running their business. And you also are given profits of the company, but it's not guaranteed. Your dividends are not guaranteed, but the voting rights are. So when they say you own part of the company, a lot of the time it's common stock that we're talking about specifically. And then preferred stock guarantees you dividends, but you don't have any say in what the company does. So the company can do whatever they want without asking you, but you're going to make money off them every time they have profit. Okay, Phil, just a second to finish writing that down. Okay, we got it? Okay. What about trading stock? There are a couple key terms to know there. When you are trading stock, a lot of the time you will meet with someone called a stock broker. These people buy and sell stock from you, and they normally take a commission fee, okay? They are paid to make good trades. You can also buy stock directly from the company. But not always, only sometimes. You can also buy stock from an organized stock exchange. So it's like official. An example of that would be the New York Stock Exchange, right? It's the big one. And you can also go through an unofficial market called over-the-counter stock exchange. Over-the-counter almost referring to prescription drugs, right? Or non-prescription. I'm just going to put OTC, over-the-counter stock exchange. And a big example of that is going to be the NASDAQ. We've heard of that one before, right? Somewhere. We've heard, oh, it's doing good, or oh, it's doing bad. And that stands for, where'd it go? Oh, the National Association of Securities Dealers. I don't know what the AQ means. It doesn't tell me. That's weird. But it's one of the world's largest stock exchanges. And then you can also invest in futures and options. That is based on agriculture. Okay? That is, I think the orange crop in Florida is going to do good this year, so I'm going to invest my money in it. Or I think the cattle industry is going to do good in Texas this year, so I'll invest my money in it. you're predicting and investing money in those agriculture markets. That's why every time the Florida oranges do really bad because of cold weather, we hear about it nationally because it affects the stock market. So, how do stocks perform? Or how do we know? Well, we can look at the stock index, which is a graph that shows what the market is doing. Things like the Dow Jones, the S&P 500, that's what those are. They tell us how they are doing. So it's called a stock index. Because an index is just like a list of things. So it's a list of stocks and what they're at right now. My light came on finally. I can see my paper now. And whenever we watch the stocks on the index, by overall what stocks are doing, we can tell if we are in a bull market or a bear market. And if you go and visit in person the New York Stock Exchange, you see the statue of a bull and the statue of a bear, right? And it's not really the animals that we're talking about, but in a bull market, it's a 20% or more increase over 2 months or more. And a bear market, it's a 20% or more decrease, okay? I always think of it as bare, like having nothing on it, okay? The floor is bare, there's nothing on it, as opposed to the animals. And lastly, we're gonna talk about bonds, okay? I'm gonna give just a second for this one. We got it? Cool. Okay, why would you buy bonds instead? Let's talk about it. There are 3 main types of bonds, okay? And the amount of money they make and how risky they are differs based on where they come from, okay? So the types of bonds are treasury bonds, right? Yeah. They come from the United States Treasury. They come from the government. It's pretty sure they're going to get paid back, so they are low risk. However, they are not high return. You're not going to make a lot of money off the federal government. They don't want you to. Okay, then we have municipal bonds. Municipal refers to either a state or local government. So a slightly smaller government. They're pretty stable, pretty guaranteed to pay them back, but not as much as a national government bond, okay? So that could be a state or city government. And then we have corporate bonds. Guess what? This is the most risky because it comes from a business. And businesses fail all the time. So you may not get money back if you invest that way. However, a lot of the time you will make more money back on your bond that you buy if it is a corporate bond. And again, the yield, the amount of money you make back, the interest rate, and the risk of default are all things you have to consider when you're investing in these things. And then the other financial things we need to talk about real quick. CDs. What does CD mean in this case? And it's not compact disc.
Circular disc.
No. In terms of a bank, a CD is a.
I literally have one.
Anyone know?
I know what it means. I just can't think of it.
It's a certificate of deposit. Okay.
I
And
literally
this-
just said that.
You did? I didn't hear you. Don't lie to me. Okay.
You said circular disc, you weirdo.
Oh my gosh. So a CD is a certificate of deposit. This is when a bank borrows your money and pays you back with interest after a specific amount of time. Okay? It can be 6 months, it can be 3 years, it varies. So, banks borrow money. And pay back. It's kind of like a loan, but this time you get to play as the bank. And then there are also money market mutual funds. So this is a high yield savings account. Okay, you make lots of interest compared to other savings account because it is based on CDs and bonds and things like that. But like I said before, it's not insured by the government and it's still easily accessible like a normal savings account. So you have someone who's in charge of the money market mutual fund and they say we're going to buy this CD, we're going to put money in this bond, and all that instead of just trading the stock market like a regular mutual fund. Okay, so it's a little less risky than a regular mutual fund. And they're going to try and make you the most money over time through those secure investments. Why are you staring at me? Freaking me out,
I'm
Jill.
staring at the board.
Okay. Okay. So, high yield savings based in CDs and bonds. So, if nothing else, today I taught you all the ins and outs of how to invest in a financial market. Whether or not you ever do, you now have a preview of how that works. Does anyone want to go ahead and have their login for the stock market game that we're going to start tomorrow? No?
Conveniently, I won't be here.
I'll just have to email it to you. I might just email it to everybody.